Something happened on January 30th, 2026, that the financial media is completely misreading. And if you walk away believing their version of events, it's going to cost you. Yesterday, silver suffered the most violent single-day price crash in the modern history of the market. It fell from $121 per ounce all the way down to $73. That's $48 wiped out in a matter of hours, a 39% collapse, the largest one-day drop ever recorded. And right now, as I'm sitting here recording this on January 31st, silver has already clawed back to $85, a $12 recovery in less than 24 hours. Every perma-bear who missed the entire 75% January rally is on television right now screaming the same thing. The bubble burst. The bull run is over. Smart money got out. But there's a massive piece of this story they're either ignoring or flat out don't understand. While that paper price was getting hammered down to $73 in New York, the physical silver market completely seized up. And what happened in the physical market doesn't just complicate their narrative, it destroys it. Before we get into the details, if you want analysis that cuts through the noise and actually shows you what's moving behind the curtain, go ahead and hit subscribe right now and smash that like button. Drop a comment so I know you're watching. And I want to be upfront with you. I will never ask you for money, never pitch a course, never sell you signals. Protect your capital and be very careful about anyone using my name to run a scam. Now let me walk you through exactly what triggered this crash, why it backfired so badly, and what I think comes next. To understand what happened, you need to understand the mechanics. This wasn't random. On January 27th, the CME Group raised margin requirements on silver futures from 9% to 11%. That's a 22% jump in the amount of cash you're required to hold to maintain a leveraged silver position. If you're running 50 to 100 contracts on borrowed money, you suddenly owe millions more immediately, or your positions get force liquidated. That's the kill switch. Then right in the middle of the crash itself, on January 30th, they raised margins again, this time from 11% all the way to 15%. In just 3 days, the cost of holding a leveraged silver position went up by 67%. Think about what that does to the market. Traders with heavy leverage start getting margin calls. Their brokers automatically close their positions. Stop losses trigger on top of stop losses. Forced selling feeds more forced selling. A self-reinforcing liquidation cascade. This isn't price discovery. This is engineered volatility designed specifically to flush out leveraged positions and shake the market clean. It worked as designed. Silver dropped $48. Leveraged traders got wiped out. Panic spread across every screen in every trading room. Mission accomplished, right? Because while New York was busy crashing the paper price, something was happening in the physical market that nobody planned for. On Thursday morning, before the crash had even started, when silver was still trading around $117, the Perth Mint in Australia sent a notice to their wholesale distributors. Now understand who we're talking about. The Perth Mint has been producing gold and silver bullion for over a century. Governments trust them. Institutions trust them. This is not some retail coin shop. Their notice stated that due to increasing worldwide demand for silver bullion products, they had accumulated a large backlog of orders on their 2026 Kangaroo 1-ounce silver coin, and were pausing all wholesale orders effective immediately until February 23rd. They were also putting monthly allocation caps in place to ensure every region still received some supply. Let every word of that sink in. Increasing demand, not decreasing. A backlog of orders, not a surplus. A pause on new wholesale orders, not a discount sale. And this message went out when silver was still at $117, before anyone in the mainstream had any idea what was coming. Now here's where it gets really interesting. The crash happened the very next day. Silver dropped 40% overnight. So ask yourself, if the Perth Mint was already overwhelmed with demand at $117, what do you think happened the moment silver hit $73? Every rational investor who understands this market just saw a 40% discount on an asset that the world's most trusted mints can't keep in stock. What did they do? They bought everything they could get their hands on. The crash didn't reduce demand, it triggered a buying explosion. Let me show you what was happening in the United States at the same time. The US Mint suspended all sales of silver and numismatic products during yesterday's chaos. Their website listed products as temporarily unavailable. Customer service told callers they were updating prices. But here's what was actually going on. Silver was moving so fast and so violently that the Mint was selling American Silver Eagles at $91, while the spot price was crashing below $80. They were taking a loss on every transaction. So they pulled the plug. They suspended everything. And when those products came back online, the price had jumped from $91 to $169. That's an 86% overnight price increase from the official government mint of the United States. Stick with me on this because it's important. The paper market says silver crashed to $73 and has recovered to $85. But the US Mint, not a dealer, not a private company, the actual government mint, is selling Silver Eagles for $169. That's an $84 premium, a 99% premium over current spot. Does that sound like a market where demand collapsed? The Royal Mint in the United Kingdom is completely out of stock on silver bars, including kilogram bars, which are the most basic, most common format in the market. In India, one of the biggest silver markets on the planet, dealers aren't just running low. They're defaulting on deliveries. They're taking payment, accepting orders, and failing to send the product. People are paying for silver and receiving nothing. And here's a detail that genuinely surprised me. Costco, the wholesale retailer where people go to buy paper towels in bulk, has implemented purchase limits on silver bullion. They're rationing it. A store literally built around selling things in large quantities is now capping how much silver any single customer can buy. That doesn't happen in a market with collapsing demand. That happens in a market where supply cannot keep up. Now let me show you the Shanghai data, because this is arguably the most important piece of evidence in this entire story. The Shanghai Futures Exchange silver vaults currently hold 455 metric tons, about 14.6 million ounces. That might sound like a substantial number, but here's the context that changes everything. In one single day this week, 26.94 metric tons were pulled out of those vaults. Nearly 27 tons, roughly 870,000 ounces, removed from a single exchange in 24 hours. At that drain rate, the Shanghai vaults are empty in less than 3 weeks. And for perspective, 14.6 million ounces represents barely 1% of annual global silver demand. 1% sitting in those vaults, draining at a record pace. And mainstream financial media is not covering this at all. Here's what makes that even more significant. China has already restricted silver exports and officially classified silver as a strategic national security asset. They're treating it the same way they treat rare earth minerals and materials used in weapons systems and AI infrastructure. So China isn't allowing silver to leave the country. And, at the same time, they're pulling physical metal out of their own public exchange vaults and moving it into private storage. You tell me what that signals. While American paper traders were crashing the price to $73 with leveraged futures contracts, China was taking physical delivery of every ounce available. One side is selling digital promises, the other side is loading real metal onto trucks. Which side do you think understands what silver is actually worth? There's another pattern here that exposes exactly what's happening. Nearly all of the aggressive selling this week has taken place during US market hours, not during Asian trading when Shanghai and Hong Kong are active, not during European hours when London's markets are open, specifically during New York hours when the CME opens and US banks are fully operational. When New York wakes up, silver dumps. Red candles, aggressive selling, prices collapsing. When New York closes, silver stabilizes. Sometimes it even ticks up during Asian hours. Then New York opens again and the selling resumes. This exact pattern has repeated every single day this week. That's not random market behavior, that's coordinated. American banks are creating paper supply out of thin air with leveraged futures contracts and digital derivatives. Meanwhile, buyers in Asia and the Middle East are accepting physical delivery, draining vaults, and moving real metal into private hands. One side is playing a video game. The other side is taking home the actual prize. And the lease rate data confirms it. Silver lease rates represent what it costs to borrow physical silver. In a healthy, well-supplied market, those rates sit around 0.3 to 0.5%. Right now, lease rates have exploded. Some reports are showing 8%, and some are showing rates as high as 39%. Think about what that means. Physical silver is so scarce that whoever holds it is demanding a massive premium just to temporarily lend it out. Lease rates don't spike to 39% in a market where supply is fine. That number tells you the physical market is broken. Let me connect all of this for you. Here's what the coordinated effort achieved. They crashed the paper price $48 in one day, the largest single-day drop ever recorded. They raised margin requirements 67% in 3 days. They triggered forced liquidations across the entire futures market. They flushed out every leveraged position. They created maximum panic. And what do they have to show for it? Silver bounced $12 in less than 24 hours. Physical premiums hit levels nobody has seen before. Mints suspended sales. Vaults continued draining. Japan is paying 60% above spot. Dubai is paying 40% above spot. The paper price says 85. Real buyers in the real world are paying 110, 120, higher. Crash the price hard enough, and retail panics. Momentum dies. Banks cover their shorts at the bottom and reset, but that playbook is dead. Why? Because the physical market is now too strong to ignore. Industrial demand for solar panels, electric vehicles, 5G networks, and military applications hasn't changed. Mine supply hasn't increased. 5 consecutive years of structural supply deficits, 800 million ounces of cumulative shortfall, haven't disappeared. The only thing that changed is the paper price got smashed and physical buyers stepped in at the discount and bought everything available. Now let me tell you where I think this goes from here. Over the next 7 to 14 days, expect a consolidation phase with continued volatility in both directions. Asian buying pressure over the weekend could push silver toward $90 to $95. But we could also see another test of $75 or even $70 if more forced liquidations hit the tape. This is the flush phase. Weak hands are getting eliminated. Over-leveraged traders are being wiped out, but physical buyers are accumulating at these discounted levels. By mid to late February, once the liquidation is complete and the dust settles, I expect the next leg up to begin. A retest of 120 is very much in play. And if COMEX inventory continues its current drain pattern, if the Shanghai premium holds at 30 to 40%, if industrial buying accelerates, a breakout toward 140 to 160 by end of March becomes realistic. Moving into April through June, this is when the physical shortage stops being a background story and becomes impossible to hide. This is when manufacturers start going on record saying they can't source material. This is when lease rates spike again and make headlines. This is when the paper pricing mechanism starts visibly losing credibility and the premium between paper and physical forces the entire system to restructure. That's when I see $180 to $220. And here's the unresolved question that nobody in mainstream finance is asking. How long can a 30 to 40% Shanghai premium persist before the Western paper pricing system loses all legitimacy? How many more $48 crashes can the banks execute before they discover they've permanently lost control of physical supply? And what happens to price when this physical squeeze, the mint shutdowns, the dealer defaults, the vault drains, the lease rate explosion, finally forces mass short covering in the derivatives market? That event will define the next phase of this bull market. Let me be honest with you about the risks, because that's what you deserve. Volatility cuts in both directions. If you are trading this move on leverage, if you are holding futures contracts with tight stops, if you are running options on borrowed capital, yesterday's crash destroyed you. Your thesis doesn't matter when the margin clerk calls. Your conviction is irrelevant when forced liquidation hits. Swings of $48 in a single session are a liquidation machine for anyone running leverage. You need to understand that before you take any position in this market. But if you're holding physical silver, if you bought metal with cash, you understand the structural setup, and you don't need to sell tomorrow. Yesterday's crash changes nothing. The fundamentals did not change. The supply deficit did not go away. Industrial demand did not collapse. The only thing that changed is the paper price got smashed, and physical buyers stepped in at bargain prices. So verify everything I've told you. Look up the Perth Mint notice yourself, suspended until February 23rd. Check U.S. Mint pricing, an 86% overnight price increase. Track the Shanghai Vault data, 27 tons drained in a single day. Research the lease rates, some reports showing as high as 39%. Follow the physical premiums, Japan at 60%, Dubai at 40%. Make your decisions based on evidence, not on panic, and not on hype. The moves ahead are going to be violent. The volatility is going to test your conviction, but the structural direction is set by supply, demand, and physical reality, not by what a leveraged paper contract says for 48 hours on a Thursday in New York. If you want me to track this consolidation phase and walk you through the signals as the next leg develops, hit subscribe and turn on notifications so you don't miss it. If this breakdown helped you see through yesterday's panic, drop a like. It helps more people find the channel. And leave a comment. Are you holding physical, or did the volatility shake you out? I genuinely want to know where you're at. The paper price says one thing. The empty vaults say something else entirely. Decide which one you believe. This is John A.G. Invest with logic, not hype. I'll see you in the next one.